2022's fourth quarter earnings season has finally closed, showcasing full year 2022's full year results. And yes, there is a lot to unpack here. To help us, we have our Regional Head of Equities Research, Anand Pathmakantan, to give us the results roundup. Welcome back, Anand, to the Tiger series. Okay, let's start with the report card question. Were the FY22 results for the stocks under our coverage in line with our expectations?
Yeah, I think overall the results were in line. We were looking at a softer finish for fourth quarter, and that's exactly what happened. If you look at our coverage universe, earnings fell 8% year on year and 4% quarter on quarter. That was largely driven by a few sectors which underperformed. A big underperformer was gloves, which turned loss-making. And that's a sector we have an underweight on, so very much within expectations. But a few other sectors also underperformed. Petrochemicals is one. Utilities and telcos also had a very soft finish. So that was why we sort of ended the year on a downbeat note in terms of earnings momentum.
Okay, downbeat. Sounds like there's a need for re-rating for these stocks. Are there any stock calls that were upgraded or downgraded since the last quarter?
Yes, so in 4Q22, a bit of a reversal from 3Q. 3Q we had a lot of upgrades and very few downgrades. 4Q we had many more downgrades. We have 18 stocks downgraded in terms of ratings, and only 2 stocks were upgraded. So the 2 stocks that were upgraded were Hong Leong Financial Group and Al Salam REIT.
Okay. Again, I think just going by the list of stocks, I've gone through the report. Can we say that besides Globetronics and Tan Chong Motors that clearly you guys basically like, most of the downgrades are to sell and the stocks that are related to commodities?
That would be accurate, yes. So of the 18 stocks, as I mentioned, that were downgraded, 7 were downgraded to sell.
Okay.
So you mentioned Tan Chong and Globetronics outside of the commodities space.
Sure.
So the other 5 were all commodities related. The first sector is petrochemicals. Very bad results across the board. ASPs are declining, demand is softening, input costs are going up. So it's a very toxic combination.
Sure.
So we cut both Petronas Chemicals and Lotte Chemical to sell.
Okay.
On the plantation side, we are looking at much lower CPO prices in 2023, about 3,400 per ton, compared to 5,100 per ton in 2022. So that's a big step down in earnings. So that means a lot of stocks are now looking quite fairly valued. So we downgraded stocks like TH Plantations and TSH Resources to sell as well. And finally, the oil and gas space. Actually, oil and gas, it wasn't so much about earnings underperformance. The sector has actually done very well. It's one of the best performing indices year to date. But we had to downgrade Wholesale to sell because the stock has done really well.
Okay.
So it's really met our expectations and surpassed it. And that's why we downgraded it.
All right, putting that aside, let's talk about buying opportunities in the market. I guess our audience would probably want to find. Are there any stocks that you have a positive bias towards?
Yeah, definitely. I don't want it to all sound doom and gloom because of the soft finish. There are definitely quite a few stocks which outperformed from a bottom-up perspective. One key pick for our list of stocks is Hong Leong Bank. That's one of our favorite banks. It continues to perform very steadily, a very high quality growth. And I think if you're looking at a slower growth environment, you definitely want to stick to the high quality banks in terms of credit costs. And Hong Leong Bank is definitely one of them. Another stock we like is Yinson in the oil and gas space. Yep. Results were in line, but the big increase in valuations for us comes from them clinching a new FPSO project.
Correct.
Yeah, so a go-go actually. So that's a stock that we continue to push to clients very aggressively. A third stock we like is Capital A. Air Asia, to many of you, they've said they were going to accelerate the reinstatement of their full fleet by the third quarter of this year. So I think there's a lot of upside to their earnings as well. A couple of smaller stocks, Padini, we like in the consumer space. Definitely a lot of down trading going on out there as economic circumstances become tougher, and Padini is a beneficiary of that. MBM Resources in the auto space, it is now one of the highest cash yield stocks on the KLCI, about 9% cash yield, quite comfortable with a net cash balance sheet. And also Leong Hub, which is a name which has just come back on the radar screen after the last 2 years of being quite negative in terms of its outlook. So I think regional demand for poultry, as well as the easing of price controls in July for domestic poultry as well as eggs, bodes well for its earnings.
Sure. Well, interesting that you said Capital A. I've also seen that Asia X as kind of in line and rated quite well. It's also been announced, I think, in the last quarter of last year that they're planning to inject the aviation assets into Asia X. and Capital A will basically be the non-aviation as well as the digital businesses. Would that be something that you guys want to look at in terms of coverage, or I mean, is there a reason why Capital A and not Asia?
Yeah, definitely. At the moment, we only cover Capital A. Exactly, it's like what you said. With the separation of the businesses on the horizon, by third quarter, this exercise should be completed. So Asia X will be the aviation hub or arm of the group, and Capital A will be digital assets. We will definitely be looking to cover Asia X. I think the stock price has already re-rated quite dramatically, and completing that exercise is also essential to lift Capital A out of PN17 status. So we mustn't forget that that is also an inhibition for many buyers.
Yes.
So once that's removed, you will see a much wider pool of demand for this stock.
Correct. And again, that's in line with the tourism sector reopening, and that's one of the plays that we have. Cool. Before we wrap up, last question. I'm sure all the audience will want to find out, will there be a revision to our 2023 KLCI index target, post-result season, budget announcement, as well as the upcoming state elections?
No, we're not adjusting the target right now. We set our target for end 2023 KLCI only in January in our 2023 strategy report. It's 1660, which is 14 times forward earnings. And that's about a 15% upside from where the KLCI is right now. So that sounds quite aggressive, but actually we never really expected the first half to be showing much upside for the KLCI or the regional indices. That's because there's still a lot of global uncertainty as to how much global economies will decelerate. And now, you've seen a resurgence in concerns about inflation and interest rates as well. So markets will find it very hard to perform in the first half. But for second half, we're much more optimistic, and that's where we see the KLCI really gaining traction. Two things. One, the interest rate inflation dynamic should be a lot more supportive of markets. And second, on a Malaysia-specific basis, once we get past the state elections for the middle of the year, I think there'll be a lot more comfort with the political situation in Malaysia, and we can move forward from there.
Okay, great. Guess we'll just have to ride just another 3 more months to the second half of market volatility and continue to look for money-making opportunities. With that said, thank you, Anand, for taking the time to share your views with us. And to our investors, you can get the latest market news and research from our Telegram channel, Trade with Maybank. Content is also available at our LinkedIn and YouTube channel. Feel free to subscribe. Please reach out to our respective sales representative or our digital channels for further assistance. Remember, stay ahead, trade smart. Thank you.
Do 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 do.